So as I mentioned, Netflix shares, NFLX, declining here in after-hours trading. Let's go to Jared Blickery, who is standing by with the results.
That's right, Brad. It's the second quarter in a row where we have a massive miss on subs. So they have a streaming paid net change of minus 200,000 for the first quarter. The estimate was for a gain of 2.5 million. Clearly, that did not work out. Revenue came in a little bit light, 7.87 billion versus estimates of 7.95 billion. EPS was a big beat, though, $3.53 versus estimates of $2.91. But when you come to their second quarter forecast, you see a bit of disappointment in those subs again. They're seeing streaming paid subscribers net drop of 2 million. The estimate was for a gain of 2.4 million. So as you noted, Brad, a lot of churn there. And what are they going to do about it? Well, we know that they've been going after shared accounts, and it looks like they might be making a bid to do that in force in the future. They're saying they estimate Netflix is being shared with over 100 million additional households. That includes over 30 million in the UCAN region. And they're saying there's a relatively high household penetration when including a large number of households sharing accounts. And so this combined with competition is creating revenue growth headwinds. A couple other notes here. Here's a quote from the report. While we work to reaccelerate revenue growth through improvements to service and more effective monetization of multi-household sharing, we'll be holding operating margin at around 20%. So the bottom line is now Netflix stock has been down as much as 19%, as you see there in extended hours trading. The bottom line is if you're sharing accounts, well, you might not be doing it in the near future.
Thank you so much for Jared Blickery. They're giving us the latest on Netflix earnings just out. And as he highlighted there, this issue of households sharing their subscriptions, clearly eating into Netflix there. You have to wonder then, are we going to then see some of these tiered structures? Are we going to see perhaps Netflix moving more aggressively when it comes to how it handles these out-of-household subscriptions? Dave, what do you think? Obviously, a lot of people at this point still sharing subscriptions, but Netflix on its own is one of the highest subscription amounts that people pay. So you have to wonder, how much longer can this really last?
Yeah, they're tweaking this, and a lot of questions remain on how exactly they're going to enforce it, how they're exactly going to track it. A lot of families spread out around the country and share passwords, so how do they distinguish between those families and people who are strictly sharing a password? That doesn't solve their biggest problem, and their biggest problem is just loss of subs. That may get them a little extra revenue, but they're going to find out how do you bring new subscribers into the fold, and there's no clear plan to do that. Minus 200,000. Now, they can talk about 1 million losses because they pulled out of Russia. That is significant. But a loss of 200,000 from an expected gain of 2.5 million, that is the bottom line for them. And clearly the success of Bridgerton is not enough. That satisfies existing users, is not bringing new subscribers over, Brad, and I don't know how they're going to do it. I think ad-supported revenue is probably the future.
I think about the content, but I think about even more than the content, it's going to come down to pricing at the end of the day. And they had to nod to that in this most recent earnings report, saying recent price changes are largely tracking in line with our expectations and remain significantly revenue positive. However, if you read between the lines on this, that automatically leads you to believe that they are seeing at least some headwind with regard to higher prices. Whether that is in certain regions that they're testing out higher prices or not, we've already seen this across the board internationally where they have leaned into some of their pricing power before. But does that pricing power still exist and remain at this point in time? And are you going to retain some of those members and be averse to the churn that we've seen in this most recent quarter? Because let's remember, they were guiding for 2.5 million additions that they were looking for. And for us to come in this light, and not even just light, a decline, that is extremely infuriating for some of the investors who have continued to place so much of the disruption annexation on a company in Netflix. Yes, they were a disruptor, but can they continue to disrupt in a landscape that it's about screen time at the end of the day? That's the big question.
I do want to bring back in our market panel here for some commentary on that. Jacqueline Remen there and Cameron Dawson there. So as we saw there, disappointing numbers there in terms of the subscribers there for Netflix. So Jacqueline, does this reflect what we might continue to see with some of these streaming giants? Are they going to all be hitting a ceiling like this?
Yeah, we think that this time period is challenging specifically for more growth-oriented companies like technology. We do think that, we're talking to clients about having both short-term views for the reality of where we are right now, as well as long-term takes on where we think things long-term will be going, and definitely think that there's a theme for technology and innovation across the board as a more long-term theme in the portfolio, while also balancing that with the short-term reality. And that is that growth parts of the market are challenged as interest rates rise and with rising inflation costs for consumers.
Cameron, also want to get your reaction on Netflix here. Of course, investors sending shares lower here in after hours trading. We've been talking at length about the subscribers that decline by 200,000 roughly. And then at the end of the day, going forward from here, the forecast. Is there anything to be positive about with Netflix right now?
Gosh, this is a big surprise to the downside, because there was expectation that Netflix would still be able to deliver some subscriber growth. And this is such a huge deceleration from what we saw last year, where we saw 4 million ads in the first quarter of 2021. But this speaks to this real big challenge for Netflix overall, which is that their costs are going up. Their cost to deliver growth is higher because of competition, because of inflation, and they're getting less for that investment. Growth is slowing. So when you have to spend more to get less, your multiple should fall. Going into this quarter, Netflix was trading at 28 times earnings. That's down from 50 to 60 times back in 2020. But the sell side, only 6% of sell side analysts had a sell rating on Netflix. So they hadn't abandoned this growth story. So the challenge we have now is, what's the catalyst to propel this into a new uptrend? It's hard to see, because I think that we're going to be stuck in this period of much lower growth and higher costs for some time.
We're going to have to leave the conversation here this afternoon, but we appreciate the commentary for certain on Netflix, as that earnings report came across, and to your point, widely a disappointment. And so we're going to continue to watch shares of Netflix, but we do appreciate the time. Jacqueline Remen, who is the Morgan Stanley Private Wealth Management Private Wealth Advisor and Senior Vice President, as well as Cameron Dawson, Field Point Private Chief Market Strategist. Thanks again.